Hello everyone. This is Lucas again. In this video, we will hear the wisdom of Mr. Warren Buffett on Apple stock. Warren Buffett has made nearly $100 billion on Apple stock so far. This makes the iPhone maker one of the billionaire investors' best investments ever. In an interview with Yahoo Finance, Buffett was asked about how closely he follows the company given his large stake in it. Because many people are concerned with Apple. Apple really has not introduced any new products lately. And Buffett's answer is always insightful, and let's hear it first.
Let's talk a little bit about Apple. Everyone always wants to talk about Apple, right? It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? You know, people are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No, if you buy a business, if you buy a farm, do you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once, it doesn't grow faster if I go and stare at it. I can't cheer for it, more effort or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others, but I bought the farm. And if it just doesn't, I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre, and now in a good year, it'd be 200. We've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that.
And so Apple is kind of like a farm.
Well, it's a long-term investment. And if you own the best auto dealership in town, the best brand, and you had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
So to sum up, the key takeaways from Mr. Buffett's wisdom are: if you have to closely follow a company, you should not own it at the first place. You buy it knowing there is 365 days a year and you are going to own it for 20 years. And you know that things are going to be different from day to day. You should not buy it at the first place if the day-to-day stuff is important. 2. Owning a stock for the long term is like owning a farm. Going up there and checking every couple weeks do not help the corn to grow any faster. 3. However, I do care over the years that it is well tended to, and I hope its yields get better. So the key topic for the remainder of this video today are to discuss these following 2 questions. Question 1. How to evaluate if the business is well tended to? Question 2. And if the yields are getting better? For a company like Apple, what makes it great is the continuous investment in innovation. Apple's has been spending billions and billions of dollars, year after year, to pursue such innovations. For readers who have not paid close attention to research and development expenses, they are found in the income statement. Typically as a footnote toward the end of the income statement. As seen, Apple spent a mind-boggling amount of money on research and development year after year. Its research and development expenses surpassed the $10 billion mark in 2016. And it has steadily risen to $18.75 billion in 2020. And it will break the $20 billion market in 2021. We all know that such research and development expenses have led to the release of various successful products such as new generations of iPhone, iPad, Apple TV, et al. But how do we quantify the yield of its research and development expenses? After all, not all research and development efforts are successful. And the world of R&D is full of questionable spending, waste, and uncertain results like any other spending. Before we discuss how we quantify the yield of its research and development expenses, we first need to measure the expenses in a different way. Instead of counting absolute dollar amounts, it makes better sense to measure the research and development expenses as a percentage of total revenue. As shown in this table and the following chart. As can be seen, the research and development expenses has been a little bit more than 4.5% in 2016 for Apple. And the percentage has been steadily increasing to about 7% last year. With that background, now let's see how we quantify the yield of Apple's research and development expenses. First, we need to understand that the purpose of any research and development expenses is to generate profit. Therefore, it is intuitive to quantify the yield by taking the ratio between profit and research expenditures. This way we can quantify how many dollars of profit has been generated per dollar of research and development expenses. However, in reality, the analysis has a few caveats that needs to be ironed out before we take the ratio. Firstly, there are many ways to measure profit, ranging from net profit, to gross profit, to before-tax earnings, etc. In this analysis, we will use the operation cash flow. In my mind, this is the best representation of a company's earning power, and it can be found in the cash flow statement. Secondly, most research and development investment do not produce any result in the same year. They typically have a lifetime of a few years. Therefore, this calculation assumes 3-year average investment cycle for R&D. As a result, we take the 3-year moving average of operation cash flow. And we then take the ratio between the average operation cash flow and the R&D expenses to finally arrive at the yield. As you can see, the R&D yield for Apple has been between 4 and 6.9 in recent years, with an average of 5. In other words, in recent years, Apple has been generating on average $5 of income for every $1 spent on research and development. Intuitively, we probably already know it is a good yield. But let's put it into a broader perspective. Let's compare the yield of R&D between Apple and Lockheed Martin, another one of our favorite holdings. In case there are viewers who are not familiar with Lockheed Martin, let me first provide a quick introduction. Lockheed Martin. Ticker number is LMT. Lockheed Martin is a global leader in defense systems, with concentration in space and missile systems, electronics, and aeronautics. Its iconic F-25 fighter jets are the most advanced in the world. So here we are, two very different businesses. iPhone versus a F-35 jet fighters. Now, first thing you see is that Lockheed spend less on research and development expenses as a percentage of its revenues than Apple. It spends on average 2.2% compared to Apple's 5.7%. This does not mean Lockheed's product is any low-tech than Apple's. The reason is that a good portion of the research and development expenses of Lockheed are covered by government research programs given its defense nature. That is one reason we like Lockheed Martin stock. Second, you notice here is that Lockheed Martin also generate about a $5 yield on its R&D expenses in recent years. This of course says something very good about Lockheed Martin itself. But at the same time, it also shows how good Apple's yield has been. Again, if you consider that a good part of Lockheed's R&D expenses are covered by the US government and Apple has to pay all its R&D expenses out of its own pocket. With that, hope you've enjoyed the video and we will wrap up here. To summarize and recap. First, hold good stocks for the long term like a farm. If you have to closely follow a company and if you cannot ignore the day-to-day changes, you should not own it at the first place. Second, but do examine over the years that it is well tended to, and see if its yields get better. Lastly, in Apple's case, the farm is well tended for, and its yield has been very competitive. Thanks so much for watching. And we will see you next time.